So if we can, I'd like to start. First of all, I'd like to thank you for being here on a Saturday morning, and we know that we are the last panel before the ultimate panel and the conclusion of this conference, and we thought that what we would do is we would take a slightly different format for the discussion today. Rather than having PowerPoint slides and someone standing at the dais giving a presentation, we thought that it might be better to have a dialogue here and talk about some of the issues in the area of financing, renewable energy, and clean technology. So the format will be different. We also wanted to give the audience lots of time for questions. We have a few questions that we have developed, and then we'll see where this goes. We have about, I think, an hour and a half. We may be able to wrap up a little bit earlier in the interest of the conference concluding on time. So I'm Selma Lussenburg. To my immediate right is Michael Barrett, and to my left, to your right, Michael Barrett, and to my right, your left, is Paul Durbin. Michael is a partner at Bennett Jones, a law firm in Toronto. He specializes in private corporate transactions and energy development. He has a renewable power development practice, and he has worked on a large number of renewable power projects. He's very familiar with the Canadian landscape on renewable power. To my right, your left, is Paul Durbin. He is senior counsel with the law firm of Miller Canfield. Interestingly, he seems to commute between Chicago and New York. Not exactly a suburb, one of the other. And he is also involved in financing capital projects and new ventures in the renewable energy sector. He does a lot of public and private project finance work, and he has worked on a significant number of renewable energy projects throughout the United States. More details on their bios are available in the handout. I was also going to say a little something about the Ontario Capital Growth Corporation, where I have been asked to serve as chair of this organization. A number of people have asked what it does, and it is relevant to what we are discussing today, which is providing financing. But it's very much niche financing. It's an Ontario government agency. It has a fund of funds. It has $200 million where it partners with people like the Toronto Dominion Bank, Manulife, and large public pension plans to put money into a fund, and that fund in turn then invests in clean technology, renewable energy, and tries to build out the Ontario footprint, if you will, in terms of the economy. It has a second initiative, which is called the Ontario Emerging Technologies Fund, and we have $205 million. And in essence, what we provide is venture or seed capital to companies that are supporting innovation or have new innovative technologies in certain defined sectors of the Ontario economy. Again, it would be clean technology, digital media, and certain health technologies. And we provide financing. We follow the market. We have a concept where we only co-invest with other private sector or venture capitalists, and we allow them to, in fact, validate the market or the opportunity, and then we follow along. And if anyone has clients that are looking for funding in those sectors, please feel free to speak to me or contact me sometime by email. I'd be happy to put you in touch with the right people. So our topic today is financing, and I thought we would start with the following. I'm going to ask each of our speakers to discuss the primary sources of investment capital for renewable energy projects in their respective countries, and what are the funding sources for renewable power projects and for clean technology companies. So perhaps I'll start this time with Michael, and then I'll pass it over to Paul.
Thank you, Selma. Good morning, everybody. On the renewable power side, for funding purposes, you have a pretty traditional model where companies look to get 20% of their capital sourced through the equity markets and roughly 80% of their capital sourced through the debt markets. On the equity side, the sources there tend to be either strategic or financial players. On the strategic side, a lot of the power utilities themselves are becoming quite active in the renewable space for lots of reasons. They see the returns, they also see the profile, those types of projects help in terms of the overall company profile. That's a very active set of equity investors in Canada. On the financial side, the federal government has set up through the tax structuring a flow-through share model, which allows for high net worth individuals and institutions to invest through a corporation, giving them limited liability, but allowing for certain types of expenses to flow directly back up to the investor. So for certain financial types, it's a very attractive model. On the debt side, notwithstanding the fact that the Schedule I Canadian banks are very healthy and have been the source of a lot of backslapping and praise in Canada in the last few years, particularly coming out of the recent economic troubles. They're not that involved in renewable financing in Canada. They do a little bit, but they're just not used to the model yet. Most of the debt financing in Canada is EU sourced, mostly because they're just used to doing it. They practiced in this market for a number of years, understand the risk profile of the projects, and that tends to be the predominant source for projects in Canada. The other significant source are the life cos. And some pension plans. And it makes sense for them in the sense that projects, I'm sure it's the same in Canada, tend to get 20-year power purchase agreements. So when you've got a locked-in top revenue line for 20 years, that type of a project model fits very nicely with the LifeCo return investment that they're looking for. So they tend to also be fairly active participants in this space.
Paul, would you like to comment?
We are primarily involved in solar and wind projects. One of the reasons I'm in New York is that New Jersey is a hotbed now for solar development. I think there are 8,000 projects, that includes residential, but there is a lot of commercial development there. These projects are heavily structured deals, project finance oriented. Like Michael mentioned, 80-20 is typically the split you'll see between debt and equity. But in the U.S., it's a little different. There's an investment tax credit here that can now, the Section 1603 cash grant can be taken instead of the tax credit. So the need for a tax investor is less urgent until the end of this year, and then you're going to have to find tax investors for these projects. The ones that we see are, again, as Michael mentioned, utility-driven projects, fully owned by utility. They take advantage of the cash grant. They enter into a long-term PPA. Typically, these are projects under 2 megawatts, but they do quite a few of them. We also have projects that are leveraged, and financing is pretty available now if you have a strong PPA with a creditworthy off-taker. We've seen projects from Morgan Stanley, JP Morgan. We hear the Bank of China is going to be active in the United States on these projects. And European banks as well, because this is where it all began in Spain and Germany. Initially, that's where the wind and solar development was really strong in the early 2000s, and now it's continuing, and the financial institutions understand the deals.
I was just going to ask, maybe it's my ignorance, but you keep on talking about a PPA.
Oh, sorry. Yeah.
So maybe I'm the only one that doesn't know what that is, but.
Yeah, sorry for that. PPA is a power purchase agreement. Okay. Essentially, it's a 20-year contract to buy all the power from a solar array. These tend to be sited on rooftops. Land-based are less common in New Jersey, where I'm pretty active. In California, they're mostly land-based facilities, and the PPAs, the power purchase agreements, are with utilities. In California, as opposed to New Jersey, they have a feed-in tariff. We'll get into this a little bit later. In New Jersey, they use a solar renewable energy credit to finance, in part, these projects.
So I heard you comment a bit about, China being a potential investor, but Michael has observed that it seems to be largely Europeans that are coming into the Ontario and Canadian market. So is that the same comment, or is there more money, I'll call it U.S. capital, that's being invested in the sector at the moment?
Right now, we say, on the debt side and on the equity side, it's domestic. The Bank of China, the transaction I was thinking, they tend to work with Chinese companies that are building projects outside of China. So, you may see them in the United States in years to come. The European financial institutions are a little bit more active now. We're seeing them on solar projects. There are a lot of European developers that now have operations in the United States, and a lot of the manufacturers of renewable energy equipment from Europe and from Asia are building facilities in the U.S. So as that occurs, you see their financial institutions migrating with them to the U.S. to finance these projects.
But you're talking about financial institutions, you're talking about private equity, right? So it's sort of an interesting dichotomy that we don't have the financial institutions in the market in Canada, and yet we have the financial institutions in the market in the United States, like the foreign financial institutions, whereas we've got private equity there. Be interesting to know what causes that, whether it's risk or government policy. We'll get to that.
Well, I'll just mention that in the U.S. you see private equity as well. Mm-hmm. So there's several different private equity firms that are very active in investing in renewable energy projects.
Okay. So maybe we should talk a little bit about the different incentives and legislative frameworks in the two countries. And rather than having Michael start off, I'm going to have Paul start off this time, and then Michael can feed in.
There are many federal and state programs that make developing renewable energy projects possible. Without the state support, you're not going to have much development. You need both of them working in unison. So what you see around the country, certain states who are very progressive on renewable energy policies will have kind of a thriving market for renewable energy development. It's the obvious ones, New Jersey and the Southwest. And New Jersey obviously doesn't have great solar. The solar is where you would expect it to be. But their legislature about 5 years ago decided to push forward with this policy, and it's really paid dividends in terms of developing these projects and increasing their supply of primarily solar power, but now they're pursuing a little bit of offshore wind. So on the federal level, you have the investment tax credit that I mentioned. On the wind side, the wind development can opt for either the investment tax credit, which is now the 30% grant, which is the 30% cost of the facility that they basically get in cash from the U.S. Treasury after the placed in service date. You have bonus depreciation, which is a major factor. It's through the end of this year, it's 100% of the project. So that's a major incentive for investing in these projects and owning them. On the state level, there are two different structures, as I mentioned. You have the Feedin, which basically means that the utilities are mandated to buy power from renewable energy facilities at a certain price. The price is subject to adjustments. In California, it works very well. There's a lot of development there. And then you have the solar renewable energy credit, the SREC markets in New Jersey and elsewhere. In Ohio, I had been working on a project over the last year that's still in play. It's a 49 megawatt project south of here at the Wilds, which is a wild game preserve. American Electric Power is behind this. They're buying the power. It's being developed by an outfit out of California. I believe the private equity firm involved in that project is Good Energies, but they're utilizing all the federal and state renewable energy policies they can and programs they can to make it happen. In addition to the tax programs in the SREC structure you have in certain states, you also have financing available at the federal level through the Department of Energy. That has not been utilized that frequently, but it's something that is used on large projects. We've seen it used on concentrated solar, but less. It's not used quite as often on PV photovoltaics.
Michael?
So the first thing to say about the various manner in which its renewable policy is developed in Canada is that for legal jurisdictional purposes, the federal government really has no role in Canada in setting targets, if you will, for renewable power. So there's no equivalent to renewable portfolio standards in Canada, either at the provincial or at the federal level. The manner in which the various provinces come at it are really in three ways. There are two provinces, BC and Ontario, that have feed-in tariff programs, and I think we all sort of understand how those work. Many provinces, in fact, most of the provinces operate under competitive bid processes. So they don't set the price at all. They just put out a call for power and invite the development community to come to them as long as they meet certain basic qualification criteria, then submit bids for contracts, 20-year contracts. The one market in Canada that's a little bit different is in Alberta. Alberta is a merchant market for electricity, so it's a spot market. You build your wind farm and you sell your electrons into the grid at whatever the price is on that day. It can be a very profitable market. The pricing tends to be quite good. The challenge in that market, though, is because you don't have the benefit of a long-term supply contract, it makes the financing of those projects a challenge. You can go out and find a merchant in the middle that will give you a 5-10 year supply contract, take a little bit of a slice on the way through on the spot market. But notwithstanding that Alberta has the best wind resource in the country by far, it has struggled to get significant number of wind megawatts on, because unless someone can balance sheet finance it themselves, it's a tough market to build in. It's really a kind of a patchwork. Ontario gets all the press because of the feed-in tariff, particularly the magnitude of the pricing that's available for certain fuel types there. But it's certainly not the predominant mechanic that's used across the country.
So as I hear both of you talk about various government incentives, both tax breaks and then other funding, here's my question. Are they mutually exclusive? So sometimes you find government programs and tax incentives where you can only take advantage of one, you can't take advantage of both. Or if you get a grant or a loan, at a certain point the government says, or the funding agency says, you've already gotten money from ABC, therefore you can't get money from this, or you already have this tax provision and therefore you can't get that one. So can you comment on that at all, whether people should be on the lookout for that? And if so, why would you pick one versus the other? So what's good about it? Did they know this question was coming?
Sure. On the technical side, most of the purchasers of power under the provincial programs, of course, are the provincial utility that's purchasing the power, and in their contracts, almost unanimously, they will say, if you are receiving any other sources of government funding, you need to disclose those, and those get netted out in your revenue for the electrons. So you're not going to double dip in that sense if you found another source of power or another source of funding. The other way that gets played out a little bit is I think in the U.S. Renewable power projects have a second stream of revenue for RECs or carbon credits that come out of those projects. And that gets built into the financing model that they go forward to the lending community with. In Canada, with a couple of exceptions, but mostly not, you cannot, once you sell the electrons to the power utility, all the environmental attributes that go with them go to the utility as well. So in Ontario, the Ontario Power Authority is collecting by the warehouse RECs and carbon credits through all of the 20-year green power purchase contracts. So, that's sort of taken off the table from folks, which I think is, as I mentioned, a little bit different than what you're used to dealing with Ontario. There's as sort of a related side note, there's a fair amount of pressure on the Ontario Power Authority to do something about that. There's an awful lot of potentially commercializable environmental attributes that they could be doing something with, and so I think you'll see in the near future something happen in that regard.
Thank you.
To answer your question, one of the issues with the bonus depreciation is that there is an offset for a portion of the grant. You get under 1603, which is a 30% grant for the cost of the project. Typically, when we approach these projects, there's 3 levels of incentives you look to. You look at the federal, which I've mentioned, and the state. And with the state, you can also, and this is very common, you look to the Department of Commerce for additional help. And oftentimes they have programs that will allow you to take advantage of state tax incentives or state financing or grants, things like that. As states across the country have tried to move into this area, they've been pretty aggressive prior to the big squeeze on their budgets in terms of investing in their commerce departments to bring in this development into their states. And part of it is obviously the job creation. One of the factors with this Ohio project, the 50 megawatts, is they're going to build a PV manufacturing facility in conjunction with it, and that's part of the deal. You're not going to have a big, heavily subsidized project like that, more than likely, without some type of major job creation. That's what's going on here.
Thanks. The panel that preceded us was talking about the supply chain, but and sort of on the transportation side. So I'm just wondering whether we could talk a little bit about what we're seeing in the renewable energy framework for the development of the supply chain in terms of financing and the opportunities that are there and how they interface with the actual output of the energy, which is obviously the game plan. And so, like, where are your clients sourcing their inputs, and how is that working at the moment?
Typically, our clients approve half a dozen PV manufacturers. They tend to come from either Europe or Asia. There are 1 or 2 in the U.S. There is a Chinese manufacturer has a facility in Rockford, Illinois, where it manufactures PV. That company is trying to get a foothold in the U.S. and also selling to Europe. So sourcing is primarily from out of the country on smaller projects. For larger projects, as I mentioned, you can sometimes attract a manufacturing facility. I work with a solar tracker manufacturer from Spain. Solar trackers are what the PV panels sit on and rotate with the sun during the day to optimize the production of power and increase the insulation of the facility. They would like to build a manufacturing facility in the U.S. The problem is in Spain, they just went through this situation where the federal government reduced the feed-in tariff. And the concern is that because there's so much political risk here, states with tight budgets, that they will reduce the level of support for renewable energy, and therefore the supply chain will be negatively impacted. So that's what's driving this. If there was more certainty long term, I think you'd see quite a bit of overseas manufacturers of renewable energy equipment locating in the U.S. There are several, and there's a lot going on in the U.S., but it could be a lot more if there was more certainty over the long run.
When you say political risk, you're talking about the programs being canceled? We don't
Cancels.
usually think of the United States as being an area of political risk.
Yeah, well, I should specify. Political risk, meaning that the programs could be either reduced, the incentive could be reduced so development isn't as commercially viable, or eliminated.
Well, the supply chain discussion in Canada, I guess the most interesting part of that is the domestic content requirements in the province of Ontario. As part of the feed-in tariff program, the government sort of makes a deal with the community that says, we'll be paying these above market rates for certain fuel types, but understand that if you're going to come and build projects in Ontario and get paid those things, you're going to have to source 50-60% of your project from Ontario-based sources, 50 for wind, 60 for solar, and that's proving to be quite a challenge, particularly on the solar side. There are really currently one significant PV manufacturer in Ontario That said, there is a rush to build in 2011 plants in Ontario on the PV side, and those are almost unilaterally Asian-based companies that have come over and are setting up, I'll call them more assembly plants than true manufacturing. There seems to be some wiggle room in the legislation around what manufacturing really means to get to the 60%. The policy seems to be driving that particular outcome, which was the government's intent in the first place. On the wind side, much easier to get there. There are a couple of Canadian-based turbine manufacturers, and the nature of those projects allow you to get to the 50% a little bit easier than on the solar side. The one part that doesn't get a lot of play on sourcing is biomass. There are a lot of people kicking the tires on very big biomass projects in Canada, and it makes some sense. You know, the wind is free, the sun is free, but the challenge for biomass projects is always feedstock, and how do you secure a 20-year supply of whatever you're going to use to drive your biodigester, basically your turbine. And so Canada has kind of a natural advantage there. There are huge swaths of the country that could be made available for feedstock for those types of projects. And they don't have the domestic content requirement restrictions at nearly the levels that other types of projects do. So, I think it's fairly certain you'll see that type of fuel type start to gain some traction, in part to try and get around some of the domestic content restrictions on other renewable fuel types.
So our discussion today is focused on money, access to capital, and we heard in the presentations yesterday that it's more expensive to invest or to produce clean energy, renewable energy, or go into clean technology. So if you were sitting at 10,000 feet and you had to decide whether you were going to go to Canada or the United States, why would you pick one or the other? And so what's so good or what's so bad about one or the other? So where is it better if you, all things being equal, so your investor is neutral, does not care whether it invests in one jurisdiction or the other? What can we learn from one or the other? So what is the U.S. doing really well? What is Canada doing really well? What are we not doing so well at? Is that a fair question?
Sure. Yeah, I'd say on the pro-Canadian side, you have a financing community that is fairly vigorous, particularly on the equity side. On the debt side, as I mentioned, the Canadian banks are a little bit slow to the game, but they're big balance sheets, and they're starting to come to the party. The nature of renewables on the debt financing side is just to kind of lay this out for a second. There's really kind of two big phases. You either fund either or. The construction side, the sort of 2 or 3 year window to build the project, and then you fund the running of it, the 20 years after, on a sort of takeout loan basis. The Canadian banks are not participating so much on the construction loan side, but they will participate a little bit on the longer takeout side once the project reaches commercial operation, because the risk profile changes a little bit there. So that community is going to be quite helpful to doing it on the Canadian side. As I mentioned, we've got great resources on the wind and biomass side. The solar side, not quite as good as many parts of the United States. You have a number of jurisdictions on a policy basis at the provincial level that are very supportive of renewable power, particularly in Ontario, but others are also taking a number of steps. Saskatchewan recently had a 300 megawatt call for wind. The maritime provinces are also putting out competitive bid procurement processes as well. So, those are things that are also occurring in the United States. I can't really say we have a distinct advantage or a leg up in any particular way, but it's certainly a market that renewables have grown exponentially over the last 3 or 4 years, and I would certainly expect that to continue in the near future.
So just before you comment, is it a cumbersome process?
It's recently become quite cumbersome, particularly on the permitting side. To give you a sense of that, in Ontario, when they brought in the Feedin tariff program, one of the things that they addressed through the legislation, the regulations there, was the patchwork process that developers had to go through prior to the legislation. It really depended on which municipality you built your project in. You could have a very favorable local council, you could have a very unfavorable local council, and it made for a lot of uncertainty coming into the market. So the government, the provincial government said, well, we're getting rid of the variability in the province, and we're just going to permit the projects through a one-window process. You get a single renewable energy approval for your project in Ontario at the provincial level, and you're done. You finish that, and it's all good. When the first one was issued in Alberta, it immediately got appealed. And it got appealed on the basis of NIMBYism, which is a significant factor in Ontario these days. You've got all sorts of anti-wind coalitions that are gumming up the system, if you will, to appeal the projects, to either on the basis of health concerns, on the basis of whether significant science was brought to bear on setback requirements, sort of any head that they can use to try and challenge the process they are doing. So getting it financed, the physical process of getting it built, getting paid by somebody are pretty easy. Getting the permitting done is getting challenging.
Between the U.S. and Canada, I mean, the obvious is that there's just more demand in the U.S. The problem is, when it comes to renewable energy development, there are only a handful of states where you can get it done, with the exception of one-off deals. So we see quite a few of special projects that are being developed around the country, and these are these project structures are unique. They're hard to duplicate. They tend to be large. As Michael mentioned, with requests for proposals in Canada, we have quite a few of those in the United States as well. I believe that in the U.S. it's going to expand, I hope, in terms of state laws supportive of renewable energy. And this is, I believe, will be driven because the companies are now gaining market share. Larger companies are being developed. Companies from overseas are coming in. These transactions are profitable, and the cost of generating a kilowatt hour, say, of solar is dropping because PV prices are falling. So it's hard for me to say, the advantages of the U.S. over Canada. I think we have clients that are open to either country. They will go wherever there's an economical project. The suppliers from Europe want to supply the U.S. and Canada, so they will locate wherever they get the best advantage. I think right now in certain states and in certain provinces, you can do really profitable projects that make a lot of sense economically.
So you said only a handful of states where you can get it done. So what does that mean? So you can't go to Arkansas or Tennessee and have a renewable energy project?
No, because, well, in terms of mass development of renewable energy projects, there are certain states that have the state law, the Public Utility Commission have set up an infrastructure so that they work financially. Those states and others in the southeast, there isn't much going on in this area. You really need the federal and the state laws both on your side. So without support of state law, you're not going to have much development.
So that sort of leads into my next thought or question, which is, if you had a clean slate and you took the view that we had a national policy in either or both countries, that we were going to get 80% of our energy from clean technology and renewable sources, what is it that we need to do today to put that kind of a framework in place, to make it attractive to private capital as opposed to relying on the government continuously to provide grants or incentives? What is it that we need to do in order to develop a framework where this is a viable proposition?
One of the problems, I think you have to look at the energy source, wind. Well, where is wind plentiful? It's in the plain states. Well, what's the problem? Why isn't there a lot of wind development in the plain states? Well, it's because the transmission lines don't run out there. So you need to expand the grid. That takes a major investment, and they discussed that at one of the seminars yesterday. So if you had a clean slate, you'd want to have a transmission grid that was aligned with the productive centers with respect to each energy source. So you'd have West Texas, you'd be able to get power from West Texas, where wind is plentiful, out into other parts of the country. You'd have solar, which is plentiful in Florida and California and in the Southwest. You'd have a means by which you can get it out to the rest of the country. You would have a national renewable portfolio standard that would allow, that wouldn't punish states, and that would allow, you would have to set it up in a way where it would work for everyone, but that you could somehow pull the power from where it can most efficiently be produced and distributed to where it's being demanded and used.
But that's infrastructure, in essence, is what we're talking about.
Yeah. And on the financial side?
Yeah.
On the financial side, in the U.S., give an example. A kilowatt hour of power in New Jersey is about 15 cents. A kilowatt hour of power in Illinois is about 8 cents. Why? Illinois has a lot of nuclear. It's very inexpensive to produce. The problem is renewable energy costs more to produce right now. Now there are technological advances, and the president spoke in the State of the Union about getting it, the PV price down to $1 a watt. Well, it's $3 to $4 a watt now to produce solar. So I don't believe in the short term that this can be done without being subsidized unless there are technological advances or, and this is not a desired result, but the alternative would be the cost of traditionally produced energy, coal, nuclear, were to go up. So you do need financial incentives on the national level, and it would be nice if you could just have a national policy that supported renewable energy, and then the states would play less of a role, but that's just not how it's set up right now.
Michael?
Yeah, a couple things. I'd say to get to 80% is a pretty big number.
Okay, well, look, I'm flexible, okay? So how about 60% for starters?
You'd have to put nukes in there. If you were going to get anywhere near that kind of, you'd have to include nukes in it. It's funny, yesterday someone's made a comment from, I forget the gentleman's name, but on the, from a hydrocarbon background. And he made a comment about, nukes are in trouble. Just, the recent Japan situation is going to cause people to question nuclear as a real baseload source of power. And I thought to myself when he made that comment, well, it wasn't so long ago we were all staring at CNN while oil gushed into the Gulf of Mexico, and yet no one's saying that the petroleum industry is going under anytime soon. So I think nukes have a very big role in getting to those kind of percentages. I'd also echo the thought that really the only way to do it on a non-subsidized basis is to make the economics of the projects comparable to their alternatives. And the most obvious way to do that in the near term is to price the externalities that go with hydrocarbons into them. And a carbon pricing is the most obvious way to do that. You start building those costs in, and suddenly the economics of renewable projects start to look not so bad. To give you a sense of it, wind is being purchased in Ontario at 13.5 cents a kilowatt hour. The wholesale price in the market is about 6 or 7 cents, so double. But the pricing at 6 or 7 cents that people quote is based on the fact that most of the power generation in Ontario is very old. The infrastructure behind that's going to have to get replaced at some point soon. So building new nukes even on budget, building new gas on budget, is going to drive the price way up from the 6 or 7 cents, quite close, if not above, the price that's being paid for wind in the current technological state it's in today. So, I don't think we're that far away from from wind being able to be quite profitable at a sort of normalized market rate. Solar's got quite a bit further to go to get there, and I just don't see any way, in the short term at least, that it's going to be without some kind of a subsidization, be a significant component to the mix. But on an absolute basis, the costs are dropping very quickly on that side as well. In the more medium term, I think the discussion around solar will change.
I don't know if I should say this, but I don't know that you answered my question, which was, how would you change the framework or the landscape to get there, right? From a legislative or other perspective. So is it leave it the way it is? Disincentives for the traditional sources?
I'd price carbon into the mix. That's certainly something I do in Canada in the short term. I know the official policy is to wait to see what the U.S. does, but I think there's good thinking around a go-it-alone approach on that front, and the next election will have a lot to say about that. But you can't, aside from taxation-based models, the federal government really has its hands tied in federal renewable portfolio standard type approaches. You're just not going to see that in Canada. So it's going to have to be done on a provincial basis. What I would change on a provincial basis to do that, I'm not sure any provincial government is given Ontario's. We have got an election in Ontario, and the energy policy will be central to where that goes. So I think other provinces will be watching very closely to see how that plays out. And so if the current administration falls, and it's felt it fell in part over its push of the Green Energy Act, I think it'll be very hard to find other jurisdictions that were willing to stick their nose out into the middle of the fray to regulate those type of outcomes.
Thank you. So I'd like to ask Paul and then Michael to sort of cover anything that they want to share that you haven't already shared, and then I'd like to open up the floor for questions. So do you want to? So really, the thought was you had presentations. We've moved to questions. Is there something that you want to tell us that I haven't asked you? And so then this is your golden opportunity. Otherwise, you're done.
Well, I think I'll echo some of the things I said, but the main driver for these states to develop these policies that encourage the development of renewables are their renewable portfolio standards. Now, in this morning, I took a look at Ohio. Just since we're in Ohio, I don't do a lot of work here, but I did a solar project here. And Ohio has 25% by 2025. So 25% of the load in Ohio will be from renewables. Well, how do they define renewables? Well, oftentimes it includes things that you wouldn't normally consider to be renewables. Here it's, I believe it's called advanced generation nuclear. So half of the standard, so it's 12.5% is for kind of the traditional renewable sources, geothermal, solar, PV, wind, those types of things, new hydro. And then you look on the other side of the ledger, another 12.5%, and there are all these other things. So the key thing, and I want to make 2 points in this area, is that you need to really drill down on the renewable portfolio standards. They exist in 36 states, but there are so many different models. The other issue is there's kind of an opt-out built into a lot of these standards in two different ways. One, if it's cost prohibitive for the ratepayer to have that amount of renewables in the load, meaning their electricity rates go up too much, and that's kind of determined by the Public Utility Commission, then they can kind of put the renewable portfolio standard or portion thereof to the side. The second way they kind of minimize the impact or reduce the development of renewables in these states is by allowing them to buy the renewable energy credits from out of state. So you may have a REC produced in California for $25, and in New Jersey it's they just had an auction 2 weeks ago. It was $415. So you can see, if you're a developer, unless you can get that $400 price, you're not going to build the solar generating facility. The RPS is key to driving renewable energy development, and in particular what the Public Utility Commission does in its implementation of it. So that's something that, you know, I've kind of looked at these across the country, and some of them are really strong, some of them weaken over time, and others are they're not going to lead to a lot of development.
Okay, thank you. Michael?
A couple things, just to sort of circle back on financing. We've talked sort of more traditional financing, equity, debt financing, but renewable financing is sometimes more accurately described, I think, as mergers and acquisitions. You know, sort of traditional M&A models, and that happens because the nature in which projects get built up is kind of like a prospector in a mining play. You've got small companies, kind of driven entrepreneurs who are out there taking the initial steps in project development. So they'll go out and they'll secure their land leases, they'll start their initial permitting process, and they may even get to the point where they get a power purchase agreement with the utility. But then they run into the wall. You know, that's not that expensive to do. Then to go out and find hundreds of millions of dollars of capital to pay for your turbines or your modules for PV, well, that's just not what those folks are about. So they then take that asset they have, generally the contract, and they flip it in the marketplace, and they go and they sell it to the large international developers who are opening offices in Canada and the U.S. and coming over here. So financing for those folks is just a model where they take it to a certain step, kind of like a prospector. Here's my claim. I'm not going to pay for digging the hole in the ground and all the rest of it, but I'm happy enough to exit at this point. So that's kind of a particular to the renewable power space, a way that these kind of projects get started, implemented, and finished on a financing basis. And particularly in Ontario right now, if you look at the number of megawatts that have been contracted for already, we're up well over 1,500 megawatts of renewable power. If all that power gets built, it's more than enough to satisfy everybody's needs, either policy needs or political needs in the province of Ontario. So the idea that there's a feed-in tariff that's still a play for people to get going and get their projects contracted, I think that ship has sailed. What's going to come in Ontario and others is more of a consolidation M&A type market, where people with the assets are then going to be flipping them and consolidating them in larger players who have the capital structure to build them out. You know, I think the next 2, 3, 4 years, Ontario and some other markets are the market will really look like a roll-up or consolidation market as opposed to an initiation or getting going type market. So,
Thank you. Questions?
Good morning. My name is Ryan Scott. I just have a question. You guys talked a lot about the front end, securing capital, permitting. I'm curious, you know, usually where the PPA, purchase power agreement, comes into the mix. Is it something you need to have at the beginning of the project, or is it something you kind of assume you'll have no matter what? And given the differences in price per kilowatt hour, notwithstanding some sort of a carbon pricing, notwithstanding capital projects, how do you make renewables attractive to utilities, and who pays the difference? I assume I know the answer to that. As far as I think it gets passed on to the end user, but I'm just curious to get your take on it.
Well, the power purchase agreements, that's on the very front end. We've had, we work with a lot of developers, and they often have entrepreneurs who come to them with projects. I have this 10-acre parcel of land. It's near an interconnect. This could be the greatest thing. They say, well, who are you going to sell the power to? And that's it. So because the power purchase agreement is one of the top drivers on the financial side. with the feed-in tariff, like in California, you have an agreement with Southern California Edison. So that is critical. Without that, you probably won't be able to attract a lot of serious discussion, and definitely not any financing. I don't know if you want to talk about power purchase agreements.
Yeah, I'd echo those thoughts. It's kind of the key piece to the puzzle. The rest of it's just kind of marginal issues, but you really need that contract in your hand to make the project saleable, viable.
And
As far as the second part about just the disparity in price between conventional and alternative, approximately twice the amount of kilowatt hour. Notwithstanding the fact that you talked about the capital investments for the old traditional powers and pricing and carbon, how do you make it attractive? So how do you get the PPA for saying, well, we're going to do this project, it'll cost you twice as much as what's available?
Well, I'll give you a couple answers to that. One, it depends on the technology. So you have PV is a lot more expensive than wind, but then you have concentrated solar, and concentrated solar, I don't know if you have seen that, but they have, I went to a facility in Spain, they have a 600-foot tower that's full of molten salt, and they have acres and acres of mirrors that redirect the sun to heat the salt. The salt is then used to produce steam to spin a turbine so that you can have 24/7 solar. Now the cost per kilowatt hour is lower for a facility like that, plus you get round-the-clock electrical service. That's kind of a new concept, and those projects are being built in the U.S. By a couple companies out west. In terms of like the cost differential, it's so great with solar that without the subsidies, it's not going to happen right now unless there are major technological developments.
But if the purchase agreement is to buy at 13 cents versus 6 cents, isn't the 13-cent agreement more bankable?
Well, it depends, because I was working on a 1 megawatt project in New Jersey with the subsidies. Okay, so this manufacturing facility is paying 15 cents per kilowatt. Okay, for power. With the subsidies, and we're going to put a 700 kilowatt facility on the rooftop. They're going to pay, I believe it's 8 cents. So the power purchase agreements in New Jersey are always lower than what they're paying market, because you get the revenue from the sale of the solar renewable energy credit.
On the who's paying for it side, it's the ratepayers at the end of the day. I'm not sure if the model is different in the U.S., but in Canada, the utility is kind of indifferent. If they're regulated to offer contracts at a certain price, they'll just end up going to the rate setting process. In Ontario, it's the Ontario Energy Board, and make an application, and they protect their buffer, and they'll just pass on whatever they have to the ratepayers to maintain their spread on the way through. So it's a risk that the political party in office faces, that people will run that mechanic through their head and look at their energy bills and decide if it's worthy of a price increase or not for all the other benefits that come with it. But ultimately, that's the process.
And then just to add one thing, when there's a feed-in tariff, like in California, the utility is required to pay a certain amount, and that obviously goes directly into the rate base as well.
Thank you.
Dick Cunningham. My father, when he wanted to refer to somebody as particularly shiftless or worthless, he said, the guy's not worth his salt, but then he never saw one of the concerts. Last couple of days, last day and a half, there were lots of discussions of subsidies, whether it's feed-in tariffs or production cost subsidies. And the general reaction from a lot of the panelists was that it's terrible because they expire. And then you're left with something you've created that's uneconomic once you withdraw the subsidies. From a financing standpoint, what's your take on that observation?
Well, I see it as a problem with siting manufacturing facilities and developing more of an industry in terms of building these parts and renewable energy equipment. We haven't had an issue when there's a mandate on a utility, say in New Jersey, to buy, under the RPS, that they have a certain percentage of their load that has to be renewables. We haven't had an issue on the financing side, a concern that they're going to pull the rug out from under them on that mandate, since it's in place now. In terms of future development, that's my concern, is that as state governments feel the financial pressure and the political pressure of certain groups that kind of shift opinion on renewables because they say it increases the utility costs of ratepayers too much, that you may not have future development. I think the development that's already in process I think it's pretty secure, at least judging by the financial investment that's in the U.S.
You said you'd been to Spain, you saw the concentrated solar. The example that those folks who posted this give was one of them was the Feedin tariff that produced the wind power explosion in Spain. And if you go from Gibraltar and drive west toward the coast, toward Tarifa, in that area, over that hilly area, there's this massive, massive collection of wind turbines. And their understanding is all that's now becoming uneconomic. The Spanish government can't keep up feed-in tariffs, and I'm not sure what comes after the and, but they do a lot of ands. And so was that your judgment as to what's happening in Spain? Or?
In Spain, there was a lot of fear from the developers that I talked to. They felt that politically things at the end of the day would not be as bad as was feared. I'm not sure.
My own personal opinion is governments that have subsidized something that has become really huge are more likely to fall out of power because they backed away from it and it collapsed than that they continued to finance it. But that's just a political assessment from a lunatic leftist, so don't listen to me.
But isn't there like a private financing issue, which is where I thought you were going, is why, if you were a bank or you were a private equity investor and you're providing either mezzanine or debt financing to the development project.
If its commerciality depends upon the government subsidy, it may not be there after a while.
Well, not why would you give it? Wouldn't your commitment be coterminous with the end of that subsidy? Because you don't want that, but then I guess there's no capacity to pay. So how do you deal with that issue? Because there's no continuity, right? And although a lot of the power purchase agreements are 20 years. So when you're in year 18 and you need new capital, what happens? Maybe, Michael, you want to go there.
Well, if the assumption in the question is that there's a risk you get issued a 20-year contract by the power authority and 15 years into that contract the rate changes, then I don't think that's going to happen. I don't, the contracts are the contracts. Once they're signed, you're locked in for 20 years. But I think if over time new contracts are not going to be awarded because the government pulls in its horns on the feed-in tariff rates, I think that's a likely outcome, frankly. I think in Ontario, you're not going to see the feed-in tariff rates you see now survive 5 years from now, maybe less. But I think that's expected. I think the idea is that you incent the development of the marketplace, the community around it, and you hope that that all drives costs down and it becomes self-sufficient through that incubation period initially.
Or the price of carbon will go up.
Yeah, or other reasons why it becomes more normalized from a financing standpoint. To answer Selma's question, generally speaking, you would find financing at the front of your project so that you wouldn't be going out 18 years into it to try and redo it. It's largely done once it's built. They're very high capital costs at the front end, but unlike a coal plant or a natural gas plant, they have no fuel costs going forward. It's virtually free to run the thing once you've built it. And so you're really not facing a refinancing risk with the nature of these projects at some point down the road. So once you got your contract, you can finance off of that. Whether you can get contracts that are financeable down the road, I think that's a separate question, and that will play itself out.
And on the equipment issue, if there's a breakdown in the equipment, you usually have a warranty. And now the big insurance companies are providing insurance to cover cover the warranty. So they're like kind of double wrapping their assets.
Michael?
Michael Robinson from Fasken Martineau. A bit of good news, a bit of bad news, and then a question. The good news, there was a comment that biomass is not getting off the ground very well. I can give you some good news there about zoo poo. The review committee.
I'm all ears.
The review committee that I sit on just approved a grant to the Metropolitan Toronto Zoo and some other partners to take all the zoo poo plus a whole lot of nasty things that come from fast food places that they want to get rid of and make a biomass operation there. And that's a grant so that they can take that project on to the point of getting their feed-in tariff. I think the bad news, and I disagree with Michael a bit on the sanctity of the feed-in tariff contracts. Anybody who watches what happened in Canada and Newfoundland in 2008, and who then looks hard at the Canadian parliamentary system, can realize that a government can pass a law which, if it's clear enough, will cancel your contract, and you have no recourse unless you're a foreigner. Because in our system, we have a Charter of Rights and Freedoms which does not recognize business interests, does not recognize corporate interests, does not recognize sanctity of property, it recognizes individual rights. And the former Premier of Newfoundland put through a law in 36 hours, right from first, second, third reading to signature by the Lieutenant Governor to expropriate assets. And he kind of neglected to, well, or maybe he really didn't neglect. The only recourse to that corporation was not under Newfoundland law, because the statute specifically said you have no recourse under this statute. The recourse was under the North American Free Trade Agreement. So the federal government, provincial governments, not having signed NAFTA, shelled out $130 million of our taxpayer money to Abitibi-Bowater. So if this government in Ontario doesn't stand, I see no reason why a new Conservative government couldn't just cancel all the contracts.
Just rip them up.
Just rip them up with a clear and specific bit of legislation. This would appall my American colleagues here. Say, what? You don't have a constitutional right? Well, we don't have a constitution. To the sanctity of property? No, we don't. So that's the bad news. Maybe you better buy some political risk insurance from U.S. Exim Bank or something if you're a U.S. person. And the question is this. Yesterday I mentioned this interesting phenomenon of the U.S. Exim Bank guaranteeing $450 million of bonds of a U.S. company so it could come to Canada, its first solar, and build a very large array of solar panels. The U.S. company will do well out of this because it's getting 62 cents a kilowatt for solar power under these feed-in tariffs. But I'd ask you to respond to this irony that I see. Japan, the United States, and the European Union are suing Canada at the WTO because Ontario inserted, not Ontario, of course, which is the party to the WTO, they included in their legislation the obligation to source the equipment for solar, wind, and whatever in Ontario, obviously designed to create an industry by virtue of a subsidy. And my off-the-top opinion, not having read all the briefs, is that it's a good case. So why is the U.S. Exim Bank, an agency of the United States, suing Ontario on the one hand, and then issuing a guarantee for $450 million worth of bonds so they can take advantage of this illegal statute?
Wow.
Okay, well, I'm going to take on the first one was not a question you asked, but just the comment on the possibility they'll tear up contracts. I suppose that's a possibility. I think the consequences of that for people's confidence in Ontario as a counterparty would be severely shaken if that route was pursued. There may be some short-term political gain for a Conservative Party to promise to do that, particularly in the rural vote as it tries to come into power. But the long-term consequences of that would be very dire, in my view.
Didn't Ontario get sued successfully under 407, where it changed the terms?
Well,
Government had to
I'm not.
ante up?
I'm not sure about the 407. I know the recently canceled natural gas plant in Oakville. One of my partners was involved in that proceeding, and that's going to cost the Ontario government a pretty penny by the time that's paid off. So, I don't know. They can pass a piece of legislation that says, "Hey, guess what? You've got no damages, even though I tore up your contract." But I don't know. That's pretty draconian, I think, and. Yeah, the way though that it has played out a little bit in the financing model is lenders and project developers aren't so much concerned that the contract itself will go away, but under the terms of the contract there is a little bit of ambiguity about what you get paid for. Some people take the view that if I generate electrons and I have them available to feed into the grid, that's what you're paying me for. Whether you use them, what you do with them, don't care. But my contract says if I generate them and I put them on the grid, you're paying me for it. Others are taking the view, and this is sort of the curtailment issue, is that the Ontario Power Authority or other authorities have the right to say, yeah, well, we actually don't need your power right now. We're at a lull, we're at a low period, time of day pricing is coming. And so you only get paid for what we use, and we're going to curtail the amount of power we use. And so there is a risk there, and that's something the lending community is very focused on, making sure that they understand the possibility that notwithstanding you got your 20-year contract, you may not see that much revenue because the buyer steps away from buying it. Under the domestic content issue, I have to be a little bit careful. Our firm was retained to take a shot at the Ontario government on behalf of Japan there. So there's not a whole lot I can say on that regard. I guess I would say the manner in which the regime protects domestic content through the feed-in tariff, and I was discussing this yesterday, is such that it is the developer itself that is required to procure through Ontario. It's not a government agency, not the Ontario Power Authority themselves or a government arm that's doing the buying under that process. And I think there is some view that because of that distinction, it may stand. But on its face, sort of stepping back out of a legal analysis, and you say, well, you're going to force people to buy here, it kind of violates the basic principles of most favored nation status and WTO principles. So, be interested in, I'll be following certainly with great interest how that plays out.
Want to add anything?
Well, since I worked at the EXIM Bank about 15 years ago, when I was there, we were focused on emerging markets. And we weren't open for business in markets that financial institutions and insurance companies were doing business. So I'm surprised that they're supporting this export to Canada, but I'd like to learn more about it. It's interesting.
We're actually doing the deal you're talking about, I think, is the Enbridge facility that was discussed yesterday.
No, it's the first solar one.
Yeah, so First Solar built a 90-megawatt solar farm near Sarnia, Ontario. And First Solar is also building, these are publicly announced deals, we're doing these two deals, the second and third largest solar farms in North America to GE and Florida Power and Light. And it's the same structure. The lender has their loan. The lender has their loan guaranteed by the EXIM Bank, and the idea, I think, is that the EXIM Bank looks at it like it's an export out of the U.S. The panels are made in the U.S., shipped across a border, so they're going to support that export activity out of the U.S. by guaranteeing the loan.
But there won't be a contract if the solar panels come in from the U.S. because the FIT contract says you can't do that.
Well, in the Enbridge case and in the two follow-up cases, those are under the regime prior to the FIT contract, which was called the RESOP program. and there is no domestic content requirement with that program. So there's no risk that the domestic content will get in the way of those projects getting done. And they're at 42 cents too. They're not at 60 cents. I mean, it's still way over 6 cents, I realize, but technically speaking.
So I'm looking at the clock, and I see Jim's lined up with a question. So I will have Jim as the last person putting a question to the panel. Thanks.
Thank you. I'm Jim McElroy. I'm an international trade lawyer, and when I see the word tariffs, my ears always perk up. And when I saw Feedin tariffs, I was intrigued by it. I didn't know what it was, and now that it's being explained to me, it really sounds to me like it's the other T word that everybody's trying to avoid with the carbon tax. I think consumers are going to see this as a tax because they're seeing it on their monthly bills. But don't take my word for it. We're going to see it within 6 months in Ontario. This is going to be a major political issue. And the issue, the way I've seen it defended by the McGuinty government when they attacked the minister, he says, I know we're paying a lot of money, but we're going to get a new industry. It's job creation, and we're going to get a new industry. My question to you is with respect to this second shoe that's going to drop. We've already heard that the local content rules make it look funny when Ontario is complaining about Buy America rules in the United States. I think it hurts our case. We've also already heard about this WTO case that's already on. My question to you is that, yes, this is a job creation program, this is industrial development, but it's not to create an industry to supply the domestic market. It's to create an industry to export. And my question is, we're going to be in another WTO dispute. My friend Dick Cunningham can correct me if I'm wrong, but this smells like an export subsidy to me. So you're going to finance an industry that's going to be landlocked. You've told them you can export, but they're not going to be able to export. And I'm just wondering, is this feed-in tariff a goofy idea and we're not going to see it anymore? Do you really think that it has longevity? You mentioned, Michael, that you thought, well, we'll lower the sweetheart pricing a little bit as time goes on and we'll continue on with it. But it sounds to me like it's not a sustainable financing option. Could you comment?
Is it a question for you?
Sure. In the short term, it's not sustainable. I don't think there's any way those rates can hold up in the longer term. But I'd agree with you that one of the principal drivers of it is to create not only the power generation, but the manufacturing base to support it all. And I also agree that the thinking is that the reason that those will be export-driven facilities. Certainly, the Chinese entities that have come to Ontario so far view it with that in mind. They're locating in Ontario to service predominantly North America, not just Canada. So when you cross that 49th parallel, I think that's where your issue gets triggered. Yeah, I mean, it's hard to see without access to the U.S. market the viability of those manufacturing initiatives. I think they are hedging their bets a little bit in the sense that there's an issue I mentioned before. I don't think, when we think of the manufacturing facilities, we think of long assembly lines and nuts, screws and bolts ending up with, but it's large chunk manufacturing. That's final assembly sort of stuff that they're doing. So,
Screwdriver play?
yeah, I think it's late stage assembly in the line, and I'm not sure that the capital investment that they're really having to put forward to do that exposes them that much. I think they're kind of hedging their bets a little bit that they'll be able to service the Canadian market, and if they find a trade issue that forecloses the U.S. market, well, they haven't built a soup to nuts manufacturing facility with hundreds and hundreds of millions of dollars at stake. So I think they recognize that issue, and that's a way that they're trying to address it.
Okay, thank you.
Well, that concludes our panel. Thank you very much for your attention and your questions. And I'm now looking to Dan, David, Chris, next steps.